I think everyone who's watching this video probably had some exposure to tech, and it was probably a relatively high weight exposure in their portfolio. And if they had that kind of exposure, they were taking a hit, at least on those stocks. And that's certainly not an ideal situation. None of us like it. None of us want to be taking hits in the market. But I think this is a healthy sell-off, and I think it's seen a lot of drawdown already. And we are up for better outcomes ahead. Let's not forget, we are not too far off the all-time high. This is not some sort of massive sell-off, but it certainly might feel like that for some of us. At least when you look on the index level, it isn't, this humongous sell-off. But if you drill down into the actual names, they've sold off quite a bit. And this is, as I said, a healthy sell-off. A lot of areas in the market, as we've been saying on this channel for a very long time, are too expensive. We want to focus on better prices. And some areas of the market just simply have not been offering great prices. For example, Tesla, not that great of a price, but it's down 30% from its high. So that is what I like to call a pretty big correction. Even Apple, down 16% from its all-time high. Now, it's Apple. It's definitely trading more expensive than it typically trades historically. But it's finally getting the credit it deserves in the stock market this year because people have gone home and, people have adopted tech more. And I believe that's a permanent shift. I advise everyone watching this video to stick to the fundamentals. That means, yes, I expect treasury rates to continue rising. But I don't expect real rates to change all that much. What are real rates? Real rates are nominal rates, the percent of the rate, which is going to continue to rise. Real rates are nominal rates, but they consider inflation. So if nominal rates move up and inflation moves at that same amount, guess what? Real rates stay the same. And I expect real rates to stay relatively similar. So I expect an inflation environment. And what does an inflation environment look for stocks? Well, I certainly don't think it looks like what's happening today. What I think is happening today is people are nervous. We have not seen inflation in the last 10 years, even in the last 20 years, and really in the last 30 years. So the market just doesn't know how to handle this. They do know how to handle rising bond yields, and that typically means stock sell-off. But there's a difference between nominal and real interest rates. And real interest rates are what I think is more important because if there is inflation, stocks will rise. Inflation is an increase in the price level, and stocks are certainly prices. How do I know that, we're not just going to see the price of food increase and all of a sudden Kroger is going to start making less money? I know this because inflation has been happening in some areas of the market, particularly real estate. Real estate has seen a massive increase in input prices. Copper, labor, land even, but we're going to forget that one for a second. And construction. Copper, lumber, and construction labor. All three of those are incredibly high right now. You can just look at the charts for lumber and copper. You will see what I'm talking about. Copper's up over 100%. Lumber's something like that. It's costing more money to build a house. In addition, the price to buy a house is up 14% year on year. However, we are currently amidst one of the hottest real estate markets ever, and certainly of the last decade. So inflation in the real estate market hasn't stopped people from buying real estate. Now, stocks, very broad term, represents the broader economy. However, there are clear signs that tell us that the broader economy is going to be hot once reopening occurs. These signs are record high savings rates. People have been cooped up inside their houses for a very long time. They've been saving cash. There's been all this stimulus coming in, cash being stored into the bank. They're not spending right now. They are going to have a lot of ammunition to live life they want to live, to travel where there's a lot of jobs lost and problems in the economy. And I expect these areas of the economy to recover. This is also part of the reason why bonds are taking up. They are fearing this inflation, which will lead to increase cash flows for the companies that are the recipients of the record high savings, which will increase earnings, which will increase stock prices, and will lead to, yes, higher stocks. I believe that is my fundamental outlook on all of this. So the way I'm seeing things, this is a misjudgment by the market on what is actually going on with inflation. I've been talking about inflation for a very long time. Not many people have. Many people have decided to stay away from the topic of inflation, but I have wanted to address it very head on. So I feel very prepared right now. And the way I see it is this is the market misrepresenting the situation. Now, what do? The market has, in some areas, sold off significantly. I named some names before. You probably have individual tech names you've been looking at that are down pretty big. If you don't have those names, and if you're looking, you have some cash and you're looking where to put it, I would suggest buying the dip. You're at a point now where a lot of these names are significantly off their highs. They are at relatively good prices compared to where they were not too long ago. And on Monday, we saw that there are certainly buyers still in this market. So I would not be afraid to buy if you have cash. Put that cash to work. I think the market is misrepresenting and misinterpreting the inflation situation and doesn't realize that it actually might be good for stocks. I don't think anybody else is looking at the housing market and applying that to stocks, but I am, and I'm confident in that assumption. So we will see what happens. I'm remaining optimistic. And until next time, peace out.